So today we are talking about vendor financing in small business acquisitions. It is a extremely attractive topic for people who are first-time acquirers, but also people who are just wondering what's currently going on in the market. What are the current terms of vendor financing, and how is vendor financing getting accepted and adopted, and how is it perceived by sellers and buyers, and how does it get applied and navigated? So we thought we'd bring some of the best that we invited here today. So I'm going to let them each introduce themselves in a little bit. But we have today with us Helen McSweeney with the Canadian Western Bank, Andrew Burt here with Fasken today, and Abby McCarr with Maxima Divestitures Group. So thank you, each of you, for being here with us today. We're extremely grateful for you sharing your time and your insights with us. Thank you to my slides getting mixed up here. But thank you today for Fasken, who sponsors our webinar series this year. They're one of the leading M&A law firms in Canada that do a ton of deals and a ton of work in this space. So we're honored to have Andrew here representing them today and speaking on behalf of what they see from their perspective. So thank you, Fasken, again for your support in this series. And if you're new to Village Wealth and you're not quite familiar with what we're up to, we're a Calgary-based technology company, and we're on a mission to make acquisitions more accessible. We work with a ton of first-time buyers who have never gone through this process before. We are witnessing the most significant transfer of business ownership in history right now, where it's estimated that 3 out of 4 businesses over the next decade will seek to exit and transition ownership to the next generation. It's an estimated $30 trillion worth of business assets across North America, between Canada and the US. And with all of that activity, entrepreneurship through acquisition is on the rise, which is the movement of people getting into business for themselves through buying an existing business instead of starting on the traditional startup path. So it's a growing trend. It's a growing movement. There are a number of post-secondary institutions that are now teaching this in their MBA programs, and the buzz is growing. But we found that 67% of first-time buyers fail to transact because of how complicated it can be. And navigating capital can be one of the biggest barriers to acquisition. And we're on a mission to solve this. So Village Wealth is an acquisition management platform built around accessing financing, guidance, providing community, as well as the marketplace that we've designed. And financing is at the heart of all of this. We work with people from start of their search through to monitoring the deal at closing, working on creative deal structurings, execution of the letter of intent, the offer letter, multi-lender management, term sheet management, and monitor the deal through to closing. And for people who are just starting out on their search and starting to get curious about what this pathway is, they usually start in our marketplace, which is a hub of qualified business buyers searchable by anyone selling a business. And it's currently used by business brokers, M&A firms, and business owners across the country to find verified buyers who are motivated and ready to acquire businesses. The team behind Village Wealth, we're a diverse team with backgrounds in sales and marketing, technology development, and finance. So we've got, I think almost everyone is here with us today: Rob, Giselle, Josh, Luke, myself. So don't be shy. If you're connected with us in any way, continue to connect with us, continue to attend our events, that sort of thing. Feel free to follow us on LinkedIn. And we have some other events coming up here shortly too, so I'll describe those in a minute. Today, the format is, please feel free to introduce yourself and where you're from in the chat. We love to know where people are tuning in from. Then we're going to jump into speaker introductions, and each of our panelists is going to introduce themselves. Then we have about a 40-minute discussion, and then we do ask that you please hold your questions until the end, and we'll save a few minutes at the end to get to your own questions. Just my last note here about upcoming events. If you're in the Calgary area, we have our next Business Buying Club meetup, which is November 9th from 4 to 6. It's in downtown this time. So if you can navigate traffic at rush hour, please join us. And then the next webinar session that we are hosting is behind the scenes with Andrew Storter, who was our most recent acquirer, who acquired a patio furniture manufacturing company in Southern Alberta. And he's here to talk about his story and his experience through going through his first acquisition. And it's a wonderful story and chapter to hear from Andrew. So with that, I would love to jump into introductions with our speakers, Helen, Andrew, and Abby, graciously donating their time. We've met before this so they could get to know each other a little bit, but really pleased to introduce them to all of you here today. So Helen, if you want to get started, we'll tell us a little bit about yourself and what brought you down this path in business banking.
For sure. And I apologize in advance. I am losing my voice. It's been a month-long, exciting journey with a cold. So, of course, it crescendoed today of all days. So forgive me for my hoarse voice. Traditionally, I have an Irish accent. I'm from Ireland. I've been here for 14 years. Since moving to Canada, I've had a variety of roles. Most recently, however, I have 8.5 years of commercial banking experience. Prior to moving to CWB just a short 9 months ago, I was with one of the big 5 banks, which has given me a lot of cash flow experience, which will certainly inform the conversation today. CWB is a national bank. We have representation right across the country, West Fraser Valley all the way to Bay Street. We recently put our first sign up on a Bay Street tower. We're very excited about that. So I'm certainly hoping to share some of the insight that I have from Canadian Western Bank, and looking forward to hearing your questions. So I'll pass it to Andrew.
Thanks, Helen. Andrew, go ahead.
Sure. Yeah, so I'm Andrew. I am originally from Ottawa, moved to Calgary in 2006 and been here ever since, so pretty much home now. I am a partner at Fasken in the banking group. So act for lenders, borrowers, all different industries, all different types of financing transactions, all different sizes. Basically, if there's ever borrowing of money or credit in any way, we're usually involved. And then also maintain a M&A practice as well, where I do a lot of kind of private company purchases and sales, whether it's share sales or assets, and again across kind of every industry, and certainly run into vendor financing frequently, and looking forward to chatting about it today.
Thanks, Andrew. Abby.
Yeah, thanks, Liz. My name is Abhishek, or Abby for short. I'm a partner here at Maxima Group. We're a full-service M&A advisory firm, so we focus on helping businesses sell or buy other businesses, and we lead transactions from the start to finish. As far as myself, I'm a CPA by trade from PwC. I've been involved in deals since early in my career. First notable one being Parkland's acquisition of Chevron in 2017, and since then I joined RBC's M&A team before coming here over in Maxima in 2021. Kind of like Andrew said, the changing market environment has led to a lot of VTBs, so looking forward to chatting about it with you all.
Thanks, Abby. Thank you all. That's great to get a better understanding of your background coming into the conversation today and the perspective that you each hold. So we're just going to jump in and kind of set the baseline and get everyone up to speed. If you're new to what vendor financing is, we're just going to start with a baseline definition. So Abby, I'm gonna lean on you for this one. What is vendor financing, and typically how does it work in general?
Yeah, so vendor financing has a few names: seller financing, vendor take-back, or VTB. But pretty much in a nutshell, it's an arrangement where the seller of the business provides financing to the buyer. So the seller is pretty much bridging the gap between the equity that that investor has, what the bank will finance, and then the enterprise value of the business. So call it the purchase price. There are other ways to bridge the gap as well. Earnouts, that's a whole separate webinar in itself, but that is another way to bridge the gap and share in the risk of the acquisition. So a typical deal will have an upfront payment that's cash on close, and a financing part, which is what we're talking about today, the VTB, which makes up the total purchase price. There are terms and conditions, as any deal has, which as far as VTBs go, it's talking about the interest rates, the repayment schedules, securities, pretty much everything that finds its way into a legal purchase and sales document. And as far as nowadays, most, if not all, deals will have a function of VTB. So banks see this as a favorable aspect of a deal since there's effectively a buy-in from the seller or equity in the deal. And Helen can dive into much of that in more detail here.
Thanks, Abby. Andrew, from your perspective, any other additional comments on how it works?
Not so much in how it works. I think Abby kind of nailed it exactly the way it is. I mean, I think there are a lot of considerations when contemplating it and entering into it, which I know we'll get into. So I'll kind of leave that discussion for now. The only thing I would add, I guess, is that again, it could be used in a share purchase transaction or in an asset purchase transaction. Totally agree with Abby. It's becoming more and more frequent and probably higher in amounts. Again, something we'll talk about later. But typically, I see anywhere between 10 to 20%. That can change depending on the nature of the deal and the amount of the transaction. But you typically see around there for the B2B component. But no, I think Abby laid it out nicely.
Thanks, Andrew. And Helen, from your perspective, from the banking perspective, seeing this vendor financing piece as buyer's equity, how is that perceived from the banking perspective? Is if the buyer doesn't have all their equity and the vendor is going to put into pieces, can you explain how that's perceived by the banks?
Absolutely. I'm happy to do so. So I would say that we're all looking to achieve the same thing, right? Think about when you're buying stocks, you're looking for a better return on your investment. And I think what we're trying to do is maybe balance some of that right now, given the environment, as Abby and Andrew both touched on, the market's changing. I agree with you, Liz. It's still a very active time, but there'll always be some recalibration in response to things like interest rate movements. Vendor financing is a way for us all to kind of share that quote unquote risk and or upside. I think that's really what it is. It's a way to maybe balance the table a little bit better, both from a bank perspective, but also I like to think that the bank is one of the partners, not unlike Andrew and Abby on the screen here with me today, and yourself, Liz, that we're trying to balance that shared risk and shared opportunity, and a vendor take back just maybe balances that for all of us.
Mm-hmm. Yeah, I love how you put it. It's the sharing of the risk. As small business acquisitions, they are risky, and changing that ownership kind of recipe puts risk in the operations and sharing it between all parties. So kind of stepping back to what are the advantages of using vendor financing for both parties? So Abby, you are kind of in this earlier in your role as the M&A advisor. When you're coaching either buyer or seller on the advantages, what are you often noting?
Yeah, so like vendor financing is a great way to bridge the gap, kind of like Helen said. And both parties have to work with their advisors to make sure that the arrangement really aligns with each party's goals and their interests and what they're really looking to do with the business in the future. So I'll kind of talk about both from a buyer's perspective. It's an alternative source of financing. So especially if traditional bank loans or external investors aren't readily available, it makes it easier to complete the acquisition because the buyers can then negotiate financing terms that actually align with their financial capabilities and the company's capabilities. And it also actually helps alleviate a bit of the strain on the cash flows because the payments are spread out over typically a couple of years. On the reverse side, for the seller, it makes the business quite a bit more attractive to potential buyers. We've said it a few times already. It's sharing the risk. So when sellers are willing to provide this type of financing, it's kind of a show of faith and confidence in the business's future success. At the end of the day, it's like you said, Liz, it's all about risk in this transaction world. It's not easy. Every transaction has its own separate nature and risk. So if the buyer is taking on most of this risk, which relates to paying cash, then the purchase price is a little bit lower. But if you're sharing in that risk through VTBs and earnouts, then the purchase price can be a little bit higher. So that's another advantage of vendor financing on the seller side. And I kind of already touched on the buyer side.
Thanks, Abby. Andrew, you kind of see these deals when they've already been negotiated, and you're papering them and making sure all the details are captured. Where, from your opinion, what are you seeing for advantages or how it's written, how the details written?
Yeah, I mean, I think I see probably like three main advantages a bit too, but definitely, I mean, certainly the access to financing is probably the most obvious one. But I think what you don't often see is, in terms of access to financing, is number one, a borrower sometimes has difficulty getting financing from a traditional lender because the lender may not understand the assets as well as the company owner, or may not lend on certain policies based on or certain intangible assets or IP. Whereas sellers often really understand the importance of some of these assets, understand the nature of the business a little bit better, maybe have a little more faith in the business just because they've been in it all this time. So sometimes it's easier to convince a seller to provide financing as opposed to a traditional lender. Like Helen mentioned and Abby mentioned, it can help you get other financing as well. It could help a bank. It makes the case for the bank to provide financing, so that could help too. So, I mean, certainly access to financing. I think the biggest thing is flexibility, though, and that's what Abby touched on. The nice thing about vendor financing is, we'll get into this more with considerations, but you can structure a vendor financing any way you want it. So, payments don't have to be your traditional monthly payments or quarterly payments or even annual payments. You could have interest-only payments for a certain amount of time. You could have milestone payments, where payments are only made based on, certain contingent events happening, or, so you can really tailor your obligations to what the business requires as far as cash flow, which I think is a huge advantage. It also allows you to keep cash in the business at the start, as opposed to paying that cash, you're paying it over time. And I think, when you buy a business, I've never bought a business, my guess is, the first year or 2 years is where, there's a lot of transition, you're getting comfortable, I think that's probably when you want more cash to help through that transition process. So I think the flexibility is really good. And then the third one, it's a bit more of a legal thing, but recourse. So when you've provided a VTB as a buyer, when you do a purchase transaction, sometimes you have claims post-close against the vendors. And that could be for misrepresentations about the business. It could be for simple adjustments, like working capital adjustments. It could be for many different things. But if you have a VTB, you can set off any of those obligations against a VTB. So it's another source of you kind of getting what you need in a really easy way and fashion, because it's already set up. If anyone has questions about that, we can raise it again later, but that would be, I think, another benefit from the buyer side. And I think from the seller side, it's just what Abby said. And I think if there's a buyer, and what I've seen, if there's a buyer that you really want, say it's like someone currently in management, or there's just an ideal buyer that's out there, but they need a little bit of help to get there to close the deal. that's when, you know, extending this vendor financing could be really beneficial for both parties. So just something to keep in mind there. And then I
Yeah,
think,
those,
yeah,
sorry. Didn't mean
and
to cut
then
you off.
no worries. I think finally, it's just you know, the sellers, from the buyer's perspective, the sellers will stay motivated. It like they're still owed money on the VTB, so they're still engaged in the transaction even post closing. They'll want the business to succeed, so they'll help with transitioning. They'll help with lots of things along the way, that is great for both parties. So sorry, Liz, I didn't think I just added that right at the end. Obviously, I like talking about this stuff, so.
Absolutely. Well, no, and you're absolutely right. It's ensuring that, you know, when you call, they're going to pick up the phone. They're still invested in the company after they leave. And thanks for noting too that part on, you know, after if there's some, you know, items or issues that arise after closing, that you've got that flexibility if it's written the right way in the purchase agreement, that you have some recourse that you can pull on, and oftentimes overlooked. Helen, from your perspective, when you know when a VTB situation comes to your desk versus a deal that doesn't have VTB included, like how are you guys seeing the difference and the advantages when there's a VTB in place?
We would, I mean, on exception, every deal, it's like baking a cake. It's a recipe, and the recipe needs to be balanced. And if there's the absence of a raising agent, for example, you're not going to make a cake. And I feel like VTB is a really important part of, and Abby and Andrew touched on this, is that commitment. Be it in a recourse situation, which is pretty dire, but I can assure you we've all seen it, on where things have gone straight from, you know, put on the books and right into a recourse situation. So I think if I think about it more, a step back and thinking about when we're analyzing a deal, not unlike any buyer on this discussion today, joining this webinar, you're clearly engaged in seeking early advice. And I think having all the information is critical. And you'll often find, and I'm curious to hear what Abby would say, but buyers, I've heard it, or sellers, I beg your pardon, multiple times I've heard sellers say, I want all my money at once. I'm ready to get out right away. And I'm so grateful for groups like yourselves, Liz, highlighting the need for early conversations on a buyer and seller side. The other thing I would add to that is we're looking for a business that can continue to go and grow. And if the seller feels that they're ready to just jump out right away with no continuity, I would think that they've, you know, likely a family business. At some point, somebody started it. There must be knowledge and passion attached to that. So if I think about it more on the abstract side, the importance of that management piece and that collective to make that perfect recipe is critical. And the vendor take back is that contribution from the seller to stay invested, to make sure that their family business or their business continues to go and grow. So when we're looking at that analysis, of course, a big portion of it is financial. And I think Abby and Andrew have touched on that sufficiently with respect to needing that combination of, you know, both personal equity or skin in the game and a vendor take back. It is important to balance the scales in terms of, you know, debt to equity. There are ratios accompanied with that most anyone will be familiar with, and please reach out to me directly to talk more about that. But I think we need to have some balance with respect to, you know, that kind of going forward plan that the seller and the buyer are both committed to seeing the business take flight. Andrew touched on something very specific just with respect to what that says about the management team as well, in terms of, you know, their commitment to making sure that the business has longevity. There's knowledge that won't be easily transferred, and the vendor take back is a big part of that, both from a financial standpoint, but also from just a longevity standpoint.
Thanks, Helen. Abby, I'm curious to know from your perspective, dealing, you know, early on with sellers, and introducing this concept of vendor financing to them, because we were, a lot of our members bring up the conversation that when they're looking at deals, the seller doesn't want to vendor finance, and they're very upfront about not wanting to vendor finance. Helen, I see you nodding. How do you manage that conversation with sellers?
With sellers about okay, yeah. So
But being open to it, yeah.
Being open to it, yeah. Like Andrew and Helen did a really good job here of kind of bringing in the point that this is a relationship that's getting built between the buyer and the seller. So the seller and the buyer, regardless of if the seller wants to hand over the keys on day one, typically that's not going to happen. There is a business transition period where, kind of like Helen mentioned, the transfer of knowledge. The business owner is the most intimate person with their own business. They know it like the back of their hand. It's their baby. So to have the expectation of all cash on close is it's a little bit tougher, and it really comes down to what are the expectations of that seller. Are they looking at just a smaller portion, a less enterprise value, or do they really want to see the company and the business grow with the buyer? So when we're talking to sellers and talking about maximizing the value of their business, there has to be a compelling story, and that compelling story is really also about the future growth. So we're talking about all different kinds. A vendor note is also very important in tax planning. In if this is retirement, there's a steady stream of income that can come or to you in principal payments over the next couple of years, interest payments over the next couple of years. So all of these factors kind of play into our conversation of what we have with the seller. At the end of the day, the seller wants to sell a business. That's why they're coming to us, and the earlier the better. And our job as advisors is to find ways to figure out the priorities of the seller and really translate that into a transaction. And most times, nobody's going to say no to a higher value. And VTB is really a strong way to maximize the value of their own business. And like I said, it's a show of good faith and your own confidence in the business moving forward.
Yeah, and if I can chime in on that, Liz, just sorry,
Absolutely.
take the floor for a second. You will hear, I mean, first of all, I want to acknowledge and recognize, like, I'm hoping what's coming across is that, as Abby said, we are advisors. Everyone succeeds together, and for us to help structure. But what Abby's touched on a few times, and Andrew also, is the levers. And you will hear this when you talk to a banker, is that there's a variety of considerations when you're assembling a deal. And so too on the buy and sell side, as Abby's touched on. And those are things like balancing, loan to value, which would be a portion of that would be the equity balance with a vendor take back, amortization, as Abby said, the valuation is a consideration, and the bank will also, I mean, albeit we get a SIM from Abby or something more robust in terms of a quality of earnings, whatever shape that takes, the bank will have their own opinion on it. And so I think it's important when you're looking at the scenario, as Abby said, to really assess where the push and pull, where are the levers. And that's an important conversation to have right from the jump, in terms of that conversation with sellers. And I think it might be even, who knows, generational or what it is, but the first conversation is the tough one where you mention a vendor take back. But I think once we educate in a compassionate, caring way, with advisors like Abby, Andrew, and myself, and Liz, of course, there can be a lot, as Abby said, with respect to tax planning and whatnot. There's a lot of benefits on both sides for a vendor take back to take shape. And so just wanted to kind of share that in terms of the conversation.
Thanks, Helen. Andrew, any comments to that question of perception by the seller?
Not much different. I mean, I think that I think what Abby said really resonated with me in terms of, you're almost going, you're selling your business, but you have to have a bit of a partnership mindset to maximize the value. And so, trying to position it for the seller, it's maximize purchase price, find the right buyer, all those things lead you to being a little bit flexible, hopefully on the VTB aspect of it, but nothing much extra to add.
Thanks. And so, Andrea, I'm going to stay with you here for the next question, because you had kind of brought it up already in the terms. And how negotiable are these terms? Like, what are typical terms and interest rates that you're seeing for these pieces? And you kind of already alluded that it can be very creative, but what are some other levers that can be
Yeah,
pulled?
yeah. So lots, certainly all negotiable. Uh, because of the time, I'll just kind of high level touch on them, and then we can always dig into more questions if we want to. But I mean, in terms of terms, the main one is repayment. How is the seller going to get repaid? And we chatted before about the flexibility. So lots of options for repayment. There could be, a set frequency. It could be based on milestones. Could be interest only periods for a time, whatever it is. Interest rates, certainly interest rates have risen, of course, over the last little while, but that'll be another term. Security is a big topic as well. So, just the mere fact that the buyer promises to pay a certain amount, that initial promise, that's an unsecured promise. So you got to, the seller will often require security as part of that, which means that they're putting up, assets to support that debt. So if there's ever any enforcement or default on the loan, they have these assets to look to as support. Now, there's a lot of nuances within security. There's which assets, which parties are going to provide security. Is it going to be the borrower, or are you going to bring in other parties as well through guarantees? Who else, what security have they already provided? So where do I fit in the ranking of security? There's lots to consider in that. Then there's covenants, and this is another topic I've had a lot of discussions on lately with clients. But so the buyer owes money, the buyer grants security, but are they promising anything for the term of the loan? Do they have to do any financial reporting each year? Do they have to give any other access to information? Do they have to maintain their business in any way? Are they restricted in any of their business operations in any way? Can they pay dividends? Can they not pay dividends while there's debt? Can they get more debt from someone else? Can they not? Can they only do it during default or not? So there's lots of different kind of considerations there as well. And then, another one that I think about is events of default. So your typical one is just non-payment, but maybe the seller says, if you go insolvent, it's an event of default. If you breach this term, it's an event of default. If you, do X, Y, and Z. And, of course, events of default could trigger other things. You could default in your bank loan with Helen if you default with your BTB, or, it could lead to higher interest rates or whatever. So lots of considerations there too. And then, the last one, but it's a big one, is relating to kind of subordination and priorities amongst different creditors. And if there's banks involved, which there usually are, and Helen can speak better to this than I can, but banks will, these days, I find, typically require a complete standstill. So what that means is you have a bank that's provided financing and got security, and then you have this buyer that owes money and has provided security. The vendor, a complete standstill means the vendor cannot enforce on the security or act on it until the bank says so. So you're at a standstill until the bank allows you otherwise. So that's another important consideration that you have to work through between buyer and seller. So I think those are kind of the main considerations and topics that I come across in negotiations and discussions. Of course, I can't speak to tax advice, so I'll throw that out there too, that none of this has anything to do with tax. Um, but
Disclaimer.
yeah, but anyway, those are the key considerations as I see them anyway from the legal side.
Thanks. I'm gonna sneak this one in because it's in the chat and it's topical right now. But how often are you seeing situations where the VTB is defaulted on and needs to be enforced?
Not very often. I've come across situations where there's going to be a default, or the rare occurrences where there is. I find that typically buyer and seller will work together in those cases to find a solution. So usually they'll kind of amend the terms to either extend the payment date or change the payment structure, or they'll do something to work together. So it's infrequent, but it does happen. I don't know if that's helpful at all.
No, it absolutely is. Thank you. Abby, any comments to add on what are the terms that are getting negotiated? Because you're usually at the table in the negotiations for these. What are some common cards that you see played?
Yeah, I think Andrew got them all. Every single deal is so different and so unique. But they're really touching on the nature of the business, the financial stability of the buyer and the seller. The big one nowadays, market conditions. Because the interest rates are fluctuating so much, that does have an impact on the cash flows. But at the end of the day, it really starts with the relationship with the buyer and the seller. There needs to be the ability and willingness to cooperate, and especially in kind of like the question mentioned, if there are recourse required, you have to be able to work together and cooperate, because it's the business that holds the value. But as far as interest rates, what we have seen in the most recent transaction, VTB now it has a 3-year repayment. It's done on an annual basis. And because of the fluctuation of the market, we're no longer seeing as many fixed interest rates. So one of the levers is, let's move that to a variable. So will it be prime plus 2, which is what ours was, or can it be just prime and then you just ride the market as it is? But as far as the other levers, I think Andrew did a great job of explaining everything else that can be negotiated.
And Helen, do you want to speak to, like, we often see it too, where the banks are requesting that the vendor finance is subordinate to the bank. Can you speak to that just so people are clear? Because I've seen it where a seller isn't totally clear about those terms and they find out, at the final hour, and it becomes an issue.
Yeah, and I think that's why it's so important. I kept thinking about when we all thought about vaccines, and it's like, get informed early, and that's what it is, right? I even feel like some of the questions are maybe a little, not to say upside down, but when you think about vendor take back or vendor financing, that's them, and they're behind everybody else, right? So the vendor financing isn't to pay you as the buyer back, it's for them to get paid the remaining piece of that purchase price. So absolutely, we will always take priority. Andrew touched on standstill, and there, first of all, I came from a non-banking background, so I can appreciate, and forgive me, maybe sometimes I do a little too much on the simple analogies, but I appreciate not understanding it and having to learn as you go on this one. So again, just to offer, if you want to contact me directly with respect to any of this, and I know Andrew and Abby would say the same, please do, because I think it's so critical that you understand the language and really understand the agreements that you might be looking at and negotiating as part of this this transaction. But with respect to vendor take back or vendor financing, they will, without a doubt, I'm not aware of any exceptions from a senior lender perspective where we're not in first position. As Andrew said, with respect to a standstill, and Abby touched on annual payments, that's pretty common. Those will usually be based on certain hurdles or covenants, as Andrew said, that are pre-agreed. So I think when you're structuring a purchase, it's really important to understand, of course, the enterprise value, and then as Andrew and Abby touched on, just what those repayment terms look like, and how you can use those different pieces to get a deal that you're comfortable with and that you can see yourself repaying over 3, 5, 7 years. I think some of the question was with respect to terms, and I think what's variable, and we've been using that word lever quite a bit in the past few questions, is repayment terms over the number of years that we're getting repaid at as a senior lender. The repayment of the vendor, that is the buyer repaying the vendor for the remaining portion of the purchase price. Making sure that the vendor's comfortable with that timing and understanding that completely. And then, as you mentioned, interest rates, right? We touched on the interest rates for the vendor take back being at a variable, and that's indicative of the rate environment right now. So again, just understanding that interest rates are probably high, likely to remain high over the next 12 to 24 months. And just, again, just making sure that you're informed on all the different language and pieces that come into this. And the questions in the chat are fantastic. They're exactly what we should be kind of responding to. I don't know if you want to look at some of those, Liz. There's probably some that
Yeah, I'm just going to jump in there now. I'm going to start with, it kind of feeds into our next questions anyway, but Aziz asks, what's the typical VTB percentage of the purchase? And so Abby, I'm going to ask you, like, when someone is just coming into the negotiations and wondering, what is appropriate to propose here, where do they get started with understanding what gets, presented in their LOI? What are you seeing?
Yeah, that's a great question. So as far as when we're having these conversations with buyers, we're looking at vendor notes. First of all, are like I said, they're a way to bridge the gap. So we have to look at cash flows, and the way to look at cash flow is first to do a valuation. So we're doing a valuation on the business. We're setting not only our expectations but the buyer's expectations. We need to have conversations with the buyers, and this is where we look to Village Wealth and kind of partner with you on it, is figure out the financial ability and capabilities of the buyer. Then we're going to compare that to the business's capabilities, and then we're able to reverse engineer with the help of the bank, so someone like Helen, to what kind of purchase price we're able to get to, what kind of cash on close we need to get to, and then we're able to attach a VTB to it as well. As far as the VTB goes, we're looking at the history of the company itself, the reputation it has, the market that it's in. There's a lot of factors that play into what we would propose as a VTB as a part of a deal, and a lot of that is having the conversations with the buyer of what are they comfortable with, how risky are they, and then we work collectively with banks, with Village Wealth, with lawyers to really put that all into an agreement. But at the end of the day, this is an investment. And an investment means that we have to figure out that, or have to ensure that the cash flow is appropriate. There has to be cash flow remaining post the debt payments. So that reverse engineering that I was talking about, that's what we're doing with the buyers to make sure that at post debt payments, there's still something left in there. What we're seeing nowadays, because the market is so volatile, something that used to be 80-90% cash on close, with the remainder being a VTB and an earnout, now has started to shift where the buyers and the sellers have to share risk in order for a successful transaction. So cash on close now is a little bit smaller, right? You're looking at 60 to 70%, and then you'll bridge the remainder with a vendor note and an earnout, but mainly a vendor note. So those are the conversations that we have. Every deal is completely different, but if you've got a good advisor and a team of advisor on your side, we can help navigate that negotiation, knowing the levers that are on each side.
They can be pulled, yeah. Team sport, definitely a team sport. Uh, Jeff, Jeff, I see your question in the comments there. If a seller opposes a VTB, what are other possible other options that can be aligned and to align interests? And Abby kind of spoke on it as well there, that earnout would be the next kind of conversation to have, sort of thing. We're going to save that one. We're going to do a whole other session on earnout. So I'm not going to get into that answer too much today. I have one more question for Andrew, and then we'll jump into the chat there and see what questions we can get through today. But Andrew, from a risk perspective, what are some of the risks for either party in doing a VTB component?
I think, I mean, from the seller's perspective, the main risk is not getting their full purchase price. From the buyer's perspective, there's a lot less risk, maybe just, the ongoing involvement. And then any specific terms. So I guess let's start there. So buyer's perspective, you're going to be owing some money. You're going to be granting security, maybe, and you're going to be agreeing to certain covenants, maybe. So the risk really comes in the devil's in the details. It's what covenants are you agreeing to, and what security are you providing. And like I said before, the covenants can be wide ranging, but negative covenants are not uncommon. So there could be covenants that you need to go to the sellers, get their approval, to the extent you want to pay dividends, or to the extent you want to obtain more debt. So in those cases, then you have a business risk that the seller may not be amenable to you doing these certain things, may look out only 100% for themselves and not take the long-term view that you are for the business. So, in those cases, it's important to, number one, know who you're going into business with and who your, partner is going to be. But number two, carefully negotiating these covenants and these terms, because you don't want unreasonable restrictions being placed on your business. And then, standard risks with non-payment and whatnot would be, they can enforce and force you into positions that you don't want to be in, as far as selling or realizing on assets and things like that. And then, as I mentioned, from the seller, certainly, non-payment would be the biggest risk, which, of course, creates this friction then between buyer and seller, negotiating these, Helen talks about all the levers, like negotiating the different levers, the different considerations, and finding that balance of risk that works for both parties.
Yeah, makes a lot of sense. And so Dylan has a question here in the chat. How often are vendor funds payable on demand? Are you seeing that, or typically follows a schedule?
Yeah, I'll jump in just because I'm not on mute right now. But no, I very rarely you see demand nature, especially immediately on demand for VTBs. Sometimes I've seen it after 2 years it's payable on demand, but certainly not right away. I mean, that may defeat a lot of the purpose and logic of having a VTB, because it technically could just be called day one. So no, so don't see demand nature. Was there a second part to that question, sir?
Let me just go back to it. No, that was it, as an alternative to having a payment schedule based on timelines and milestones. Abby or Helen, do you have any other comments on the risks?
No, I think Andrew got the main ones that a buyer should be focused on, and just to take it one step further, this is really where due diligence comes in. When you're looking at mitigating the risks, there's a lot of factors that the advisor can guide you through. The lawyers can work with you on mitigating those risks, and some of the main ones, based on what Andrew had mentioned, even whether you're on the buy side or the sell side, is really the financial stability of the buyer or the company. So you're looking at the health and the risk of the acquisition. Personal guarantees can come into play here as well. But another main due diligence item is having agreements, which can be very, very long and detailed, but they need to be crystal clear and legally binding. So everything that we're talking about at VTB, as far as interest rates, repayment terms, security, collateral, we talked about, is there a demand? Sometimes buyers will look to prepay so that they can avoid extra, interest rates. So all of these things have to get put into legal documents, which only comes from the diligence that gets done on that. So that's the only thing I would add.
Thanks for that. And it kind of speaks to the tone that no deal, two deals are alike. They're all so unique. This is not, there's not a box that they all fit into. And I'd love to leave off with what you guys are seeing in the market, if you have any other comments about what's getting seen. But before I leave with that question, I'm just addressing some of the comments in the chat here. Alex, you had asked about tax advantages, and we do plan to do a session on tax advantages. But if any of you have any comments on tax advantages for the seller, Abby, you kind of already mentioned it, that you have this conversation with them, that there can be advantages to deferring receipt of the full payment at close. Does anyone have anything to add on that point? No.
It's probably a separate.
Yeah.
Yeah, that's fair. Yeah.
That's what I'm thinking too. Yeah. Alex
yeah.
will watch for future webinars. I've got someone lined up for that one specifically. So hang tight on that one. And Josh brings up a point. We talked about how vendor financing can often keep the business owner invested in the company and invested in the future of the business. But he brings up a point that Walker Diebel is a common book that's read, probably the most popular book on acquisition entrepreneurship right now. And it's Buy Then Build. If you haven't read it, definitely recommend picking it up. And a lot of the MBA programs are teaching that the transition period be 60 days and no more, and get the owner out as quickly as possible. Abby, what are you seeing for transition periods?
I have not seen 60 days yet. So that would just show that there is the utmost confidence in their own business, which is excellent. But a buyer, like I was saying, the seller really knows their business so intimately. To have the expectation that somebody else, a buyer, can come in and learn the entire ins and outs of the operation in 60 days that's pretty short. Typical, at the very, very minimum, we're seeing 6 months. But typically what will happen is, in the agreement, the negotiation is that there's 12 months. Between 12 and 18 months is very normal. It's very common to expect a vendor to stay on. Especially when there's a vendor note, it just adds motivation for the vendor to stay and really pass on that knowledge appropriately. Another key factor that we didn't really talk about, but is very important, is the employees. When a transition happens, employees are the ones that'll go home and really worry about their job. So having that previous owner, previous vendor there for more than 60 days is really beneficial, to have at least a cycle under the new buyer's belt, to feel comfortable, not only for their own business knowledge, but also for the employees to feel secure. But as far as transition goes, as I was saying, 12 months, 18 months is very typical. A lever in there could be that, listen, if I'm the buyer, and if I'm comfortable within 6 months, then we can agree mutually that the vendor can leave a little bit early. But even in this transition period, the first couple of months is full time for that vendor. Then they could go down to 4 days, to 3 days, to part time, to then become a consultant. If there is a vendor note attached, it's a couple years. And most vendors, most sellers are really passionate about their business, so they want to make sure that it's continuing properly. So most of them are very open to, give me a phone call. I'll happily pick up. No, I'm not working 40 hours a week, but I'm more than happy to pick up a phone call and guide you in the right direction.
Thanks, Abby. We're definitely going to have to host another session because the questions are flying in here. So Alan puts a question in here. So while I chat for a second, I'll pose all of you to read Alan's question in the chat. But I'm going to mention that we do, for members of Village Wealth, we do private roundtables. And so our roundtables are different from our webinars. Our roundtables are where everybody who comes gets to ask their own questions. It's not just me up here asking questions. So think about, if you want to be participate in our roundtables, look at our subscription options and check it out. We do it every month, and it's really an engaging session where your voice is heard. So I encourage you to check that out. In response to Alan's question, and this was our last question anyway, we've got 2 minutes left, guys. So I thank you again for being here, because we'll cut it off pretty promptly. But typically, and as we mentioned, there is no cookie cutter solution for this, but what are you guys seeing as the most common length of term and interest rates right now that are happening? Abby, do you want to start off?
Yeah. So like I was saying, the most recent LOI that we've had was a 3-year VTB. It was an annual payment. There was options of early payments, and I saw a very interesting question about cash flow sweeps. Again, completely different conversation, but this one had the ability for a cash flow sweep. The interest rate was prime +2. And there was a lot of collaterals. It was a very asset heavy business, so it was easy for a bank to get comfortable on that side, and very okay with the VTB. The VTB itself was 25% of the purchase price, and it was just cash on close and this VTB.
Wow. Andrew.
Yeah, thanks. And before I get cut off, anyone, I know Helen mentioned this before, feel free to reach out anytime. Happy to chat. Just call me, whatever, no problem. I think typical term I see is anywhere from 3 to 5 is pretty typical. As far as interest rates go, anywhere from like 6 to 12. And then you could have higher default rates. Payment terms, it's still typically annually, but you do see some like with interest only periods or quarterly or milestones or whatever. Everyone I've done lately has had security. The covenants really depend on whether there's a standstill with the bank. Because if there is a standstill with the bank, the vendor needs some kind of lever to put pressure on the buyer to repay. So in that case, you can put in some covenants around the business, and maybe a default interest rate and things like that. So that's kind of the typical structure.
Thank you, and thank you for offering to provide your ear to anyone who wants to give you a shout. Helen, we'll wrap up with you, and then we'll let everybody go for lunch.
Sure, and I think what's interesting is just, I think the first place you begin before you even get to the point of executing an LOI is talk to the bank. It is arranged right now. Back to your point about the 60 days exit, I just want to circle back to that for a quick second. This is a small business acquisition. I have no doubt that large companies absorbing smaller companies, that might make sense, but in small business and in this environment, I would say that those transition periods are longer. And again, it is very subjective. So just to kind of offer some perspective on that, there was a lot of
Thanks for adding that.
Yeah, no, I think that's really important because the context is everything, right? And I think it's the same with any arrangement. We've talked a lot about covenants and interest rates and structure. And what we find sometimes, not often, particularly not with partners like Abby, Andrew, and Village Wealth at all. On the contrary, Liz and I've worked through a deal before, and it's been great having early engagement. But I think that's really important if you are buying a small to medium-sized business. There is not to say a larger degree of risk, but probably not a pre-existing cash flow, right? Unlikely that you already own a business and that you're adding another business into it where we can maybe rely on the existing cash flow to support the business transaction that we're looking at. This is likely a standalone transaction. And with that in mind, it brings its own unique, I don't want to use the word risks, opportunities, let's call it. But having a discussion with your bank early is really important. And we are an advisor, a trusted advisor. There'll be pain points along the way with any of us. But certainly having that comfort early, I think, is critical to the success of your deal. And I would say that that's changing, that the appetite and conversation is changing periodically, kind of like our interest rates right now, where we might have had more appetite for less vendor financing. Andrew and I met for coffee late last week and chatted about that change and what's being asked for, going from as little as 10 to 30%. And I think that is very much unique to the transaction. But early engagement with your bank will be an important part of this next journey. Just so we can maybe offer advice or at least share where we might have comfort around some of those considerations when constructing your LOI. I'm certainly excited to learn more about upcoming transactions.
Thank you all. Thank you all so much for your insight. It's a very active chat today, so that shows always that we picked a good topic. So we'll let everyone go for now.